should you use a family trust? In the next few minutes, I'm going to walk you through when a family trust makes sense for Australian business owners and investors, and more importantly, when it doesn't. Because here's what most people don't realize. After working with over 150 clients who invest through structures we manage, I've watched family trust go from the default choice to something we now actively talk clients out of in many cases. And the reason isn't what you'd think. It's not that trusts are bad. It's that for most business owners, paying more tax upfront in a company at 25% and keeping that capital working is actually better than the tax flexibility that a family trust promises. Let me show you why. In the next few minutes, I'll show you when a family trust genuinely helps you, the hidden costs and the ATO scrutiny that most accountants don't warn you about early enough. And finally, the better structure that we're using now for 99% of our investing clients that keeps more money in your pocket long term. Let's start with what a family trust actually costs you, because this is where most people underestimate the burden. You've got the setup, which is $2,500 to $3,000 minimum. Then every single year, you're paying at least $2,000 to $3,000 in accounting fees. And that's if you have an individual trustee. Add a corporate trustee and you're adding ASIC fees on top. So over 10 years, you're looking at $25,000 to $30,000 in fees alone. That's before we talk about the tax planning, the annual resolutions you need to document before 30 June, and the compliance burden. Now, here's the math most people miss. If you're a business owner and you're using a family trust to invest, you need to get that money out of your trading company first. That usually means paying yourself at your marginal tax rate, let's say 47% if you're, earning well. So you earn $100,000 in profit in your business, you take it out and pay $47,000 in tax, leaving you $53,000 to invest through your family trust. Compare that to a bucket company structure, same $100,000 profit, pay 25% company tax, and you have $75,000 still working for you. That's $22,000 more capital compounding every single year. That is the cost of ignoring this. So when should you use a family trust? There are really three scenarios where they still make sense. Scenario one is you're in a high-risk profession and you need asset protection. If you're a doctor, a director of a trading company, or in any profession where you could be personally sued, you do not want assets in your personal name. I've never owned our family home in my name. It's always been in my wife's name or in a structure she controls, because I'm the one running the business and taking on all the risk. Family trusts work here because they separate the person taking the risk, you, the business owner, from the person controlling the assets, the trustee, often your spouse. If something goes wrong in your business, your investment property or share portfolio held in a trust is protected. Scenario two is you need flexibility for estate planning. A family trust doesn't die when you die. It has an 80-year lifespan, which means you can structure how wealth flows to the next generation without everything being locked up in an estate. If you want control over how and when beneficiaries can access money, say your adult kids, a family trust gives you that control in a way that personal ownership does not. Scenario three, you're a high-income employee with a big tax gap in your household. If you're earning $200,000 and your spouse is earning $50,000 and you're building an investment portfolio, a family trust can give you the tax flexibility to distribute passive income to the lower income earner and reduce your overall family tax. But, and this is critical, you need enough passive income to justify the $2,500 a year cost. If you're only generating $5,000 to $10,000 in rental or dividend income, the fees eat away at the tax savings. So what should you do instead? Well, there's an insider strategy most accountants still aren't talking about, and this is using companies to invest, not trusts. We manage here over 250 million for our clients. Only 5% of that is invested through family trusts. Almost everything now is held in companies or super funds. Here's the difference. The old way, what most people do, is you have a trading company, it earns $100,000 profit, and you distribute it to yourself personally and pay 47% tax. You're left with $53,000 to invest through a family trust. The trust distributes income to beneficiaries each year at their marginal tax rates. The new way, what we do now, is you have your trading company, which earns $100,000 profit. You divide it across to a separate investment company, sometimes called a bucket company, and pay either 25 or 30% tax. You have then $75,000 still working and compounding in the company. The family trust owns the shares of that investment company, so you still get the control and flexibility, but the investing happens at the company tax rate, not personal tax rates. That means $22,000 more capital stays invested and compounding every year. You avoid triggering personal income tax until you actually need to draw that cash out. You still get asset protection and estate planning benefits because the trust controls the shares. You don't need a family trust to do the investing anymore if you're a business owner. You need a company structure to hold the investments with a trust controlling the shares. Now, let's talk about the traps, because this is where family trusts become dangerous if you don't know the rules. Red flag number one is distributing to adult children without proving economic benefit. The ATO released guidance in 2022 under Section 100A. If you distribute income to your 19-year-old uni student, the ATO now expects you to prove that money was actually paid to them and used for their benefit. This means bank statements showing the money hit their account, receipts like car, uni fees, or rent. If you can't prove it, the ATO can go back to 2014 and re-characterize those distributions, meaning the trustee pays top marginal tax rate on all of it. I'm talking six-figure tax bills, and that's on top of the tax already paid by your adult child. Red flag number two is lost trust deeds. I've seen this destroy families. If you lose your trust deed and the ATO audits you, you have to go to court and reconstruct evidence that the trust even existed. We had a client with a property in a family trust. The trust deed was lost. When he passed away and tried to transfer this property to his son, we spent months in court trying to prove the structure actually existed. And it was an absolute nightmare. Keep your trust deed safe. Digital backups, multiple copies. Red flag number three is assuming trust protect you in a divorce. They don't. The family law courts look straight through trust structures. If you're setting up a family trust thinking it'll protect assets in a separation, you're wrong. The courts treat it as a family asset regardless. So here's how to decide whether a family trust is really for you. You don't need a family trust if you're a sole trader or you're just starting a business. Use a company instead. You don't have at least $50,000 of passive income or investments. You're a business owner who wants to reinvest profits. Use a bucket company structure instead. Or you want simplicity and low admin. You probably do need a family trust if you're a high-risk professional and you need asset protection. You're a high-earning employee with a big tax gap in your household and significant passive income. You want estate planning control, or you're using it as the shareholder of an investment companies, not the investor itself. Bottom line is paying 25% tax in a company and keeping that capital working beats distributing it at 47% to get some sort of tax flexibility that's now heavily restricted. Most business owners are better off with a company structure and then a trust as the shareholder, not a family trust doing the investing. Now that you understand when a family trust works and when it doesn't, the next decision is which structure should you use if you're starting the business? Because most people get this wrong from day one and it costs them years of tax savings. So watch this video here. I've broken down the three main options: sole trader, company, and trust, and when each one actually makes sense. But if you want us to review your specific situation and show you whether your current structure is costing you money, I've left a link below to book a strategy session with our team. See you in the next one.